out of your portfolio to put equity in the business to keep the real source of your wealth afloat, or your house payment, or something like that, which means that exactly at the time these credit market failures happen, risk assets decline in price. And so there actually is a correlation between the risk-free rate and the risk assets. And it's the risk-free rate goes up and the risk assets go down, which means it doesn't even belong on this axis anymore. It belongs out there. It's a risky asset with correlations that can be used to diversify other kinds of holdings if you believe the correlations. Unfortunately, for the last 20 years, the correlations have all been going up. That's the Boltzmann story I was talking about transactions costs and global markets and all that. But wait, it's worse. During a crisis, they all become one. And they all become one because everybody has to sell all their stuff because they ran out of cash, and there's this huge shadow price of cash. Interesting research project. It's very, very, very difficult to measure this shadow price of cash during non-price clearing market situations because the Wall Street Journal does not publish the number and the government does not publish the number. It would be a fascinating dissertation to try and measure with proxies that, track it, put it in a portfolio framework, and use it to explain, to describe market equilibrium. These are the actual correlation coefficients during this last episode, using end of 2006 to early 2008 is sort of the heart of it. And basically, things that were low correlated become very, very highly correlated, at which point diversification fails and your portfolio crashes. So, footnote, not for today. In the portfolio I'm running in Switzerland, 40% of it is in cash. It is in cash-like things because during these credit market failures, the mirror image of the high shadow price is that there are all sorts of opportunities where you can actually play a market maker role in cash-like assets and get huge payments for doing it. So people need to own more cash than finance theory tells people they should own. Conclusion number one. This is actually U.S. bank loans over the last 12 months. This is the stock of bank loans minus what it was 12 months ago. So it's the change in the book. And as of today, bank loans are $300 billion lower than they were 12 months ago. Bank loans are all to small businesses. These are business loans of banks. Big businesses don't borrow money from banks. Small businesses make all the jobs. So when you shut off banking, you're shutting off working capital, you're shutting off jobs and leading to political pressures. In this situation, what happens is we have this model in our textbooks that says if the interest rate goes up, we'll sit around the board table, we'll say, I think I won't make that investment that I was going to make before, and we'll have this chart, and we'll cancel our investment plans. That is not the thing that matters. That's a zero. I have never, in 40 years of boards and making investment decisions, I have never seen an investment decision made or not made based on the interest rate. I'm sorry. It just doesn't work that way. What does matter is that you have loans in place from the bank that you've already taken. And you have converted those loans into inventories, raw materials, work in process, labor forces, buildings, and all these other things. And on a certain day, the bank knocks on your door and they say, we'd like you to pay the loans back. At which point, you've got highly illiquid assets already committed, and you have no way of getting them back. And the pressure on you to do that forces you to sell assets in the secondary market, and you end up with collapsing used everything prices, sort of the eBay world. And that balance sheet collapse plays a role in the GDP economy that's attached to it. We're going to skip this part. This is all like how do you invest money and make a lot of money. But basically, this view of the world leads you to think about investing like a meteorologist, where you're trying to identify disturbances that create return gaps that will last long enough so you can run over there and collect them. And not all of them are like that, but some of them are. And those are the actual 7 or 8 that I have in our portfolio right now. And we build things for, or are in the process of building things to collect back those things. There are really 3 kinds. One of them you would think of as broken markets, which is non-equilibrium things. A second one is sustainable growth differentials, which are really Asia's growing high rate for a very long time relative to the old industrial economies, and that creates return gaps that are persistent because you have to move a lot of capital to close them. And the third batch are policy changes, sometimes driven by these chaotic events we're talking about, like healthcare policy or education policy, or name your own list. What I want to do now, in the one more minute, I want to show you just a hair about what all this can be used for in finance theory. There we go. No, this one. If you take the words I've been using and you turn it into a model of valuation of equities, and then you push it through Monte Carlo experiments, you get something that looks like this. First time I heard about portfolio theory, it was in 1972, and I was a student in Gene Fama's class, and he had a cowboy shirt on, and he said, a security is really a return distribution. So I said, I wrote it down. I said, okay, he's my professor. Never made any sense to me why that should be true. God didn't descend on me and say, thou shalt be a return distribution, but that's what they knew how to do. And James told me in one sense, look, portfolio theory was really just taking the average return, which is the first moment of a distribution, and adding the second moment on it, which is the variance. And then they added kurtosis and skewness, and all. Those are basically just derivatives of the thing you just talked about. But if I say, wait a minute, what's the fundamental here? The fundamental is, if you run a business, things like sales, prices of your products, wages of your workers, productivity, tax rates, those are all things you don't control and you have to know in order to figure out how much money you're going to make. And as an investor, when you buy companies in the private equity world, you actually model those drivers, push them through, I think, uncontroversial financial statement math. I don't know anyone arguing over like what's cost of goods sold. But when you do that, out the other end poops free cash flow. And free cash flow happens not just next year, but for a long time in the future. Actually, the duration of the S&P viewed as a bond is more than 30 years, because it's steep. So if you do that, you say, how do I turn that into the value of a business? Well, you then have to discount those future free cash flows and subtract debt. Things like discounting, powers, dividing are nonlinear things. And so I can take the first set of arithmetic and turn those distributions of drivers into distributions of profit, and essentially their qualitative properties don't change. But once I start valuing those things, the qualitative properties of the driver distributions change dramatically. So what I've done here, just to show you what I mean, I've taken there's a valuation model, which is basically what you learned in your first finance class. I've taken three things: sales growth, cost of capital, and then later on we'll add in the price around the intrinsic value. Because basically if you're doing all this estimating and you're discounting, what you're really saying is what you think this thing ought to be worth. Its fundamental or intrinsic value, which is the present value of the discounted free cash flows, blah, blah, blah. But that is all about determining what does this thing you own produce. It has nothing to do with what the market will pay you for that thing. That's a separate question. That's the finance theory question to me. Is will the market pay you the mean of that distribution, and how close to it on average will it pay you? So there are really two kinds of stochastic events going on here. One in and around the company, and the other in and around the capital market. I think, and the distribution, everybody's arguing about whether it has a fat tail or the thing we now call postmodern finance theory, which I think is a load of crap. All that stuff is arguing about the same old distribution, which is really the compounding of those other two things together in a way that I don't think you can use logic to say anything. So I've separated them apart. And what I've done is, in the couple of pictures I'll just show you here for a minute, is said, let's let those things be like everybody wants them to be. They're going to be normal. And just what you think they ought to be, okay? Sales growth and all that stuff. But I'm going to push them through this valuation model, which makes them nonlinear.
And I'm going to show you what ends up coming out the other end.